Welcome to Macro Hive Conversations with Bilal Hafiz. Macro Hive helps educate investors and provide investment insights for all markets from crypto to equities to bonds. For our latest views, visit macrohive.com.
My name is Mirza, and I'll be speaking to Liang Ding about China's economy and markets. Liang is currently based in Shanghai and has close to 20 years' experience as currency strategist, China economist, and portfolio manager. He has spent most of his career based in Germany and recently returned to his hometown of Shanghai, from where he speaks to global asset managers through the Macro Hive platform, advising them about the macro and policy outlook of China. We are recording this podcast on the 7th of August. The S&P 500 is at 5250, 10-year bond yields are at 390, dollar China is around 718 after having bounced from a low of around 708. Before I begin, I wanted to address one key question that a lot of our institutional clients are asking us right now. The question is, will the large rate cuts that are now priced by the market prevent a deeper sell-off? In other words, does the Fed save the day? Well, let me answer this in two ways. First, let's apply the historical lens. And when we look at the 13 rate cut cycles since the 1970s, the first thing that jumps at you is that this is usually a very volatile time. In fact, the start of Fed cut cycles is much more turbulent than the start of hike cycles. Now, that makes sense because most of the hike cycles have ended up over-tightening and triggering a market meltdown. This then forces the Fed to do a U-turn and then start cutting rates. Stocks usually find a bottom, roughly 1 to 2 weeks after the Fed starts cutting. And that's the usual story. The most recent example of this that listeners might remember is at the end of 2018, when the S&P 500 fell 10%. That sent the Fed Chair Powell from saying rates are well below normal to signaling a future rate cut in the space of one FOMC cycle. Now, the current episode is very different from this historical pattern. And the key difference is this: the Fed didn't over-tighten. Bond yields peaked almost a year ago. Banking liquidity has remained ample. The Fed didn't cause this. And since the Fed didn't cause this, then cuts might not fix it. In fact, I would argue that if the Fed does an emergency rate cut today, or does very large, like 50 basis point cuts, as some people are predicting, it might spook the market even more. We could end up with an even deeper sell-off based on the narrative that the Fed is panicking, economy must be in trouble. So be careful what you wish for. Now let's roll back the historical lens and look at the situation in the market today. The stock market right now grapples with high concentration risk. For example, the biggest drop in single name stocks have occurred in the mega cap space. And this shows how much of the recent panic is really about AI. In addition, broad market valuations are still very high. S&P 500 is trading 20 times forward earnings, the highest outside of from 2000 to 2021. Valuations, as some people might recall, peaked in 2021 at 23 times forward earnings, and the projected increase of 12% for next year is almost entirely based on a prediction of rising profit margins. In short, the market sell-off is not about policy being too tight, but fears that growth may disappoint. Now, we at Macro Hive are not in the hard landing camp, but we expect volatility to continue in the near term as the market works through a derating of the growth and earnings outlook. Well, I hope that sheds some light on the issue. Macro Hive subscribers can log into our website to follow our thoughts on global macro in more real time. Now let's move on to our guest. Greetings and welcome, Liang. It's great having you on the podcast again.
Yeah, hi, Mirza.
Well, great. Let's start with the current state of the Chinese economy. When we last spoke in December, you diagnosed China's growth problem to be a demand-supply imbalance, with too much supply and too little consumer demand. Now, 7 months have passed and a lot of other things have happened. But has this basic picture changed in any way, according to you?
The simple answer is no. We can look at in different ways. The first is if you look at industrial production actually the season-adjusted average industrial production has slowed a little bit compared to last year. But if you look at domestic demand, Chinese fixed asset investment grow at roughly the same pace like last year. But most importantly is if you look at the Chinese retail sales. So the season-adjusted dropped to only 0.1% monthly compared to 0.7% last year. So it shows a really rapid fading of pent-up demand after COVID reopening. Of course, you can now say China, the export demand is quite strong. We have, I think, 7.5% export growth on the renminbi term and 4% export growth on the dollar term. But if you look at more direct measures, like something like the growth rate or inventory compared to the growth rate of revenues, you can still see that the growth rate of finished goods, the inventory is grow faster than the growth rate of revenues. Right. Or if you look at the ratio, for example, the ratio between the sales to the industry production compared to last year at this time, it is still around 0.5% lower than last year. So in very short, I think we still have the problem with the most supply and demand, the imbalance, and the external demand is not able to compensate for the declining domestic demand.
Got it. Thank you. Well, China reported Q2 GDP, I think a couple of weeks ago, and for the first half as a whole, they printed 5%. Surprise, surprise, exactly in line with the official target. However, indicators like Chinese demand for crude oil and the widely watched credit impulse, they paint a much weaker picture. So what's the reality? What's truly happening with growth?
Yeah, I think this is a very good question, especially if you look at the oil demand. I think what this basic tell us is actually, again, the story of the fading pent-up demand. Let me tell you why. We have a very strong export growth or import growth of oil last year, that's 10% of 2023. At the same time, we also had a very strong production growth of gasoline and diesel last year, also 10%. It's roughly the same. But now, if you look at now the situation, we have a rapid declining production of gasoline and diesel. At the same time, we have also a drop of the oil import. So what I want to say is, despite all discussions of electrification of the transport in China, if you look at also the production of electricity, it is roughly at the same pace as on average every year. So we cannot say it's only due to the EVs, so they consume less oil. So on average, I think the reason is due to the declining pent-up demand. If you look at the service sector, I will do more deep dive in the service sector. We can see a slowdown of the tourism growth and slowdown of logistic area, but also the slowdown in the retail sales. So these are areas I think where the diesel and the benzene are consumed. Going to come to your question about growth, clear. In the first half year, the growth rate in the real term was 5%. Compared to last year, 5.5% is a little bit lower. But if you look at details, again, industrial production and service sector, we see a pickup of the industrial production compared to last year. So this is not a month-over-month, just look at the first year growth rate. But at the same time, so we have a 2% drop of the consumption of the service sector. So the export-driven industrial production was all able to compensate for the loss in the service sector. I think this is what the divergence between, I would say, strong industrial production, good GDP, and weak oil demand. What is there as actually is a weakening service sector or weakening pent-up demand, in my view.
Got it. Thanks very much, Liang. Now let's talk about inflation, or rather the lack of it. I understand deflation is a taboo word in China, isn't it? You're not allowed to say deflation. You're not allowed to say Japanification or make any such inference. But how would you characterize the trend in prices across the economy, and what does it tell us about the state of aggregate demand and supply?
Yeah, I think this is very interesting. As you say, the Chinese the growth rate is on track with 5%, but actually China has also an inflation target set by the two sessions at the beginning of this year. It was 3% inflation target. So it's just far behind the inflation target. And
so just to be clear, this is not kind of like a official like central bank target, but this is more, would you say it's like a desired level, or is this like an actual?
It is not explicitly set by central bank or so, but you can, if you compare all the data, you can actually calculate the implicit or implied the growth target for the inflation rate. So this is the situation, and if you look at very directly, look at the GDP deflator. Also in Q2, we have fifth consecutive quarters with a negative GDP deflator. Okay, if you compare it with Japan, also from 1994 to 2014, in 21 years, Japan has only in 11 quarters, or less 3 years, as a positive GDP deflator. So it is surely not a good perspective, for China. So going back to China, we have clearly an improvement of the GDP deflator from -1% last year to -0.7 in Q2. And if you look at CPI also turned positive from negative last year, and we have also a 2 percentage point increase of PPI in line with, for example, PPI in EU, for example. But if you look at where the improvement came from, it came from the commodity prices. They are priced not only in domestic market, but in the international market. And the worse the problem is actually on the headlines, the improvement. If you dig into detail, if actually you have a worsening of the problem with deflation and a broadening of deflation. Let me tell you why. If you look at, for example, the downstream sectors, which is less affected by the commodities prices, actually we don't have an improvement on average, but in some sectors, like in the EV sector, the car sectors, we have actually a worsening of deflation. And I think that the most concerning problem is that in Q2, we have the first quarter in the whole history, maybe since 2000, we have also a negative deflator in the service sector. So in the past, it's all about the oversupply, production more than demand, but we have first time in the history actually a negative deflator in the service sector. I think so this makes the problem, of course, a little bit difficult, right? I think it's not only about I think that the deflation in the service sector is surely not due to the oversupply. There's no one talk about oversupply, overcapacity in the service sector. I think one reason is just due to a weak income growth. So actually we will have problem. China have to if you read the July Politburo readout, I think the first time in the recent history they ask for a cleaning up of overcapacity in some sectors. But how can you do that how can you do that? Okay, if you lay out first, there are many of these, especially in the new energy sectors, they have strong involvement of local government. So if local government, no one, I think, is willing to close the factory. If you close factory, they will have even more income loss. We have drag even more on the service sectors. So it is a really a difficult situation now.
Right. I mean, problem seems to be about how to raise demand. But let's talk about the property market, because I've been reading some news that maybe there's some signs of it bottoming out, at least in the tier 1 cities. I remember a couple of months ago, there was considerable excitement about the PBOC's new relending program, which would basically give money to SOEs to buy out the excess housing inventory. We called it housing market QE, for example. But where is that now? Where are we at in the property market and the stimulus around it?
Yeah, I would say I would say at best we have a mixed situation now. So in Q1, you can remember we have a re-acceleration of housing market slump, and in May, so China the government actually introduced the two supporting measures. The first is to cut significantly the mortgage rates and lower the down payment. And the second is, as you mentioned, the introduction of 300 billion relending programs for the SOEs to buy the finished but unsold homes, in addition to the previous 100 billion funding or lending program for the building of the affordable housings. I think first we have in June, we have some positive news. You can remember we have 50% month-over-month growth rate of new home sales in June compared to May. And it was actually, there are lots of seasonalities in China housing market, but if you compare to history, it is actually one of the biggest jump in June in the last 10 years. And you mentioned whether there are some improvement in the tier 1 cities. Actually, we have in Shanghai also for the first month since September last year, we have an increase of housing price both for the existing homes and new homes in Shanghai. So that also looks very, very encouraging. But below the surface, again, there are still very concerning signs. If you look at, I think one of indicators, it's currently very important to look at the loan, the credit to the developers. So the effort of the banking sector to support the developers to finish the unfinished homes. So the buyers, I don't worry about whether they will get their home delivered. So in June, right, we didn't see a continuation of improvement of the loan creation or loan to the developers. The first, I think, is concerning. The second is also, if you look at the total financial data, you can also see a further drop of household demand for the long-term loans. And another thing is you look at high frequency data. So for July, we see the July new home sales based on the high frequency data. I think that the sales in July is actually below the value of the previous three months, previous 6 months, and previous 12 months. So it looks that the improvement in the June is more, it's maybe caused by the seasonalities. Usually at the end of the first half year, there are strong closing of contracts, same contracts. Now moving on to the second question regarding the SOE buying of homes. The official number is not released yet, as with how much of the relending programs has already been granted. No, it's not yet. But according to some media report, in Q2, in total is from this 400 billion program, in total 25 loans has been granted until at the end of Q2, compared to 15 billion in Q1. So what does it mean? It means actually if you're using average housing price in China, it can with the $25 billion you can buy 2.5 million square meter apartments, compared to 400 the inventory of 400 million finished but unsold homes. It is of course very small. Also, if you compare it to the planned purchase or building of affordable housing, 150 million this year, the 2.5 million is just very, very small. So the problem now, I think it's the government. I think that there are many actors are involved in this process, right? There are developers, and most of them are also SOEs. As you have on the other hand, you have also SOEs to how to avoid the moral hazard and how to, I would say, how to bring the.
And what you just said about existing plans already, so it sounds like SOEs already have some planned purchases, and this program could actually just be part of that, so it doesn't necessarily completely tack on top of it. Is that right?
No, they have. I think that the program. I think that this has already. I think that of course this and introduced the program into May. But actually, we have also a previous version of this program.
Right. Okay. So there is some overlap involved. And so just to get the full summary of this section right, so you said that essentially in June, we did see some signs of acceleration, but we haven't seen that momentum continue more recently. Is that a fair summary?
Absolutely. So It is, we have to wait and see, right? I think we
Yeah.
need to find how to find out working process and reconcile interest between developers and the SOEs. I think SOEs surely demand more financial support, not only a cheap loan, but they also want some subsidies from government. They have worked out.
Let's move on, Liang, to the topic of policy support. So we just had the much awaited third plenum last month. Most China watchers that I've read dismissed it as business as usual. However, voices within the inner circles, like that of Wang Yiping, who's an advisor to the PBOC, they seem to acknowledge that the economy is off track. It's quite rare, I think, to hear officials or semi-officials saying things like that. I mean, he suggested some very radical solutions, including helicopter money for households and setting a hard inflation target for the PBOC. So I just wanted to ask, like, how strong are these voices calling for a drastic pivot? And what do they signify about a change in economic strategy?
Yeah, I think this is a very good questions. I think I read some these very well argued speeches about stimulus in these directions, helicopter monies, and so on. And the one argument for them is say, okay, the problem with these programs, of course, the risk of a rise of inflation. But currently in China, actually, we don't have the problem. So we have actually the luxury. We can actually, yeah. So we can actually, we don't have to fear about inflation. But on the other hand, we can support the economic growth. But I still think the probability is still quite low for this kind of, I call it radical measures. I will tell you why. The first is that if you follow the Chinese, I would say Chinese way of policy making, is usually before they introduce some big programs, usually they start with some experiments in some tier two cities. So they collect some experience, and usually there were some rumors. So you have some reportings about these programs. So you will have, I think something like experiment in tier 2 cities, they do some helicopter money or something like that. And I think it would be, for me, a more stronger signal than a speech from someone. I think the very interesting anecdote is that actually the Caixin reported, I think 2 months ago, that in a tier 2 city, in 1 year ago, into a tier 2 city, the government has actually started experiment of SOE buying of homes. So they have experimented with different approach, and now they have some experience, so they roll out this program. So I think so. This is first reason. I think this speech is interesting, but I don't see it as direct sign of measures of this kind of measures. I think more. For me, yeah, I think the second is, I think China has still, I think if you read the June policy bureau Politburo meetings, you can see the emphasis now for China is really a quick implementation of already announced, but I would say poorly implemented strategies. The first thing is the issuance of local government, special purpose local government bond. So in the first 6 months, China has only issued 1.3 trillion special purpose local government bond. The plan for this year is 3.9, so it's far behind the plan. The reason is that it's getting more and more difficult to find meaningful projects, but it looks that the government will be flexible about the use of these fundings. So even they can use this money to pay back some unpaid bills or something like that. So government can has money to do as a support in the consumptions, for example. I think that this is first area. The second area is surely the first thing. Yeah, the second is the implementation of the SOE buying of homes. I think still a lot can be done, and the policy makers can still provide the subsidies and to improve the sentiment on the housing sectors. Another thing, I think what the government is pushing now currently is government has upgraded the upgrading program, the large-scale upgrading program for the production equipment and for the durable goods. So this time they use the 300 billion proceeds from the ultra long government bond and provide direct subsidies for the enterprises and for the local government. China has already introduced this.
Could you tell us a little bit more about this upgrading program, Liang? Like, so the money goes from the government to corporates, and then where does that money then go into? What are the upgrades?
Yeah. I think it's very interesting. I think maybe we will see the same story for the SOE buying of homes. I think last year China introduced also already this larger scale upgrading program, right? You can remember. But at that time, all the financial support was cheap funding. So again, something like lending programs, and it was, I think, only 20 billion renminbi. So the first step. So it doesn't work. So now the government say, okay, we will give you direct subsidies if you investment in new machine, and especially if you investment in new machine with low energy consumption, I will direct give you subsidies. So I think this is we can see again here a gradual actually step up of the program. If they start with small scale, it doesn't work, they can do more. Another thing is to upgrade the trading program for the cars and household appliance. This program has also announced, I think, a couple of months ago. At that time, the central government said, okay, the local government, you have to find some funding. So you have to support your consumers. But this time, the central government say, okay, I will give you 115 billion renminbi, saying you can support your consumers. And it is actually the first time that China started a trading program to support consumption with actually debt funded, right? It's first time. In the past, you have also some kind of this trading program, but it's all funded through the budget of the government.
Could you give us a bit of a sense of scale of this program, Liang? I mean, I've been noticing that car sales data has been quite soft in China recently. So, yeah. I mean, how much of the funding that's coming, how important is it as a part of the total auto market?
It's difficult. I think the consensus view among the local experts is actually, if it is, you don't know. You don't know how the consumer will react, right? If you give them 10,000 yuan or 20,000 yuan, will you still buy? If you have old cars, I think they already buy second car. Are they willing to buy new cars? So I don't know. We don't know the effect. But the consensus view is it will be around 1% GDP impact.
Okay. If that's quite substantial. So combine all of these effects. Are you turning more optimistic about the growth outlook?
Okay, I think the government is, I think it's difficult, right? I think if you look at the very soft actual QT growth rate, only in the quarter is grow only 0.7%. So in order to reach the 5% growth target in this quarter and next quarter, China has actually to deliver a double the growth rate than Q2, has to deliver 1.4%. So it is really difficult. At the same time, we have maybe see a weakening of external demand, and we will see a further declining of pent-up demand in the service sector, in retail sales. So the question is that whether the government spending will be enough. We should not forget that service sector is actually two-thirds of China's economy. So you can do a lot in the production, you can do a lot in the fixed asset investment, but if 1% drop of the service sector, you need 2% increase from other sectors. So it is challenging, and I hope it works. Yeah.
Okay, so the conclusion from the July Politburo and the third plenum for you is basically more vigorous implementation of policies that have already been announced.
Right.
But what would be new news? Like what are you watching out for? What kind of announcements do you think would be considered as genuinely sort of new policies or new support measures?
Yeah, I think actually, I think it's due to lack of my fantasy. For me, it is really difficult. But I think for me, okay, we know what this third plenum has introduced reform in certain areas and so on. And for me, actually,
please don't list all 13.
Yeah, no. I think for me, I told you, for me, I think just focus on one thing. For me, maybe the most important, maybe also the most difficult reform is the land system reform. It's actually, I think if it doesn't do well, China can avoid or prevent Japanification, right? But of course, due to the very difficult ownership structure of the land, they are actually separated, right? The rural land and urban area land, and also there's also coupled with the separate welfare system with entitlement, entitlement. So this is really, it will cost a lot of money, and with lots of interest, different interest groups in this reform. So I think it's difficult, but I think it's I think it's if it's done well, I think it's could have a very big impact on the economy. At least I think, or say, we should know, China knows, it's don't waste the crisis. Maybe it is, there are lots of talk for a long time about Hukou system reform, the land reform. Maybe this is really time to push forward with reform.
Okay, got it. Trade tensions are a hot topic. Most people talk about China and the US, especially in the context of a potential second Trump administration. But it seems to be getting broader now, no? With EU and Brazil recently announcing tariffs on Chinese EVs. What are your thoughts on the Chinese dominance in this sector, and how do you see this playing out?
Yeah, I think this I think it's a difficult question. As for me, the Chinese strategy is, of course, is to I would say to say, okay, we will provide level playing field also for the foreign investors, foreign companies. So at the same time, maybe you can also be less restrictive regarding our exports. On the other hand, I think the Chinese strategy is really to diversify the market, export market. So I think this is actually I think the strategy in this in the different ways, in the two different ways.
Okay. Well, one strategy could be just to produce more in the consuming countries. For example, I remember Trump and his Republican Congress, his acceptance speech, he didn't say we don't want Chinese cars. He said we don't want Chinese cars made in Mexico. He said if if China invests in the US and makes factories here, we will buy those cars. So, I mean, that's just him talking, for example. But do you think producing more in the countries to which China is selling, how would that go down? Do you think the corporate structure, do you think the government in China, do you think China is prepared to export its industrial expertise?
Yeah, I think sure. I think definitely. I think if you look at China's focus, if you look at the European countries, China is already, I think, the biggest FDI provider for the Hungary, and I think this is really something what China is really pushing forward.
Got it. So that could be a point of collaboration perhaps in the future. All right, let's move on to markets, Liang. So you painted a very sobering picture on growth, but you're bullish on the Chinese stocks. Please tell us why.
Yeah, as my thinking is very simple. If you look at, there are lots of talk about the sentiment, investment sentiment, a lot of talk about trust investment, whether the investment trust the market or not in China. But actually, if you compare the blue chip index CSI 300 with the earnings forecast, actually you can see that there's a very close relationship. Actually, Chinese stock market is traded very fundamentally. So my argument for long Chinese CSI 300 is also based on just fundamental situation. I don't speculate about U.S. presidency. I also don't speculate about whether China will start buying of equities and something like that, or reform of SOEs. I just look at very simple what drives the earnings of the Chinese equity market. If you look at the Chinese CSI 300, actually 75% of the market capitalization comes from the industry companies. So, and last year, China, or this year, the industry profit has turned positive. And if you look at the main drivers for the industry profit, one is the export growth, and second is the PPI. I think both export and the PPI has improved a lot in the last 6 months, but still they are at a very low level. I just simply think it is highly the downside risk to go back to the level in 2003 is just very, very low. I think China has 3 very bad years from 2021 to 2023. We have 3 crises in time, right? Housing market crisis, we have income crisis due to COVID, and we have export a sharp drop of the exports. So really very bad time. I think the downside risk is limited. Okay, how can improve it? As I said, I think we have a very in the first half of this year, I think that the growth is actually completely driven by the export, and looks now that China has really to start with fiscal support for the economy. So I think this is the reason. I think this China has really to fiscal support both on the investment side and consumption side. I think this will have positive impact on the earnings growth. So this is the reason for my call for long Chinese equity market.
Okay. So even though you think that deflation is persistent, you also think it's in the price effectively.
I don't think it will. I think it's downside, limited downside. If you look at the global PPI development, right? I think we have overall improvement. If you look at, of course, the companies, they are also utilities, they are also energy producing companies. So they profit from the improvement of the prices. They have actually now the improvement of Chinese PPI came also from the energy near sectors. They have improved from the problem is the downstream sectors like cars. So they haven't improved.
Okay, got it. All right, and the RMB has strengthened recently along with the yen on the back of collapse in US bond yields. These moves could very much continue in the run up to the September FOMC meeting, but then we also have the possibility of another Trump presidency and a second trade war. So between all of these factors, what do you see as the most important drivers that will shape your view going forward?
Okay, I think, of course, the Japanese yen appreciating is very excessive, right? But if you look at during the period of 10 days, but if you look at Chinese yuan, it has only appreciated, I say 2%. Yeah. And this largely aligns with the change of interest rate differentials. So, yeah. But that's the surface. But if you look at the details, I will say actually the market has very strongly adjusted the expectation against the Chinese yuan. Why? Because I think that due to the heavy intervention from the PBOC, actually the RMB was already a little bit overvalued. So before the correction, so now the correction is of course much smaller. But if you look at the NDFs and if you look at the onshore, the forward markets, where in areas where the government not intervene, you can see actually a much sharper correction of the sentiment, positive sentiment for the Chinese yuan. The question is, of course, whether this improvement can continue. So looking at the data in the last 10 years, which covers the complete periods of the current fixing regime, with actually a free flow of trade-related flows and also investment FDI-related flows, but a restriction of the capital market-related flows. What we can see is that actually in the midterm, I would say in 1 or 2 or 3 quarters, actually the main driver for the dollar CNY is actually not so much the interest rate differential. Actually, the most important driver is really the balance of the dollars. So if you look at, we have only the Q1 Bank of payments data. It shows, if you look at the basic balance, right? This is the real money flows, real economy flows. It's trade surplus plus net FDIs. It's dropped to in Q1 this year, dropped to only $11 billion. And in the entire history since 2000, we have only 2 quarters with a negative basic balance. And it looks very, very likely that the Q2 number will also be negative again for the 3rd quarter in the entire history. Why? The first, if you look at the quicker monthly data from the banking sector, the cross-border payment, the FDI-related payment and the service sector-related payments, they have already deteriorated. They're worse than in the Q1. And of course, you can talk about the export. You see, okay, in June, we have record high trade surplus. I think it's 100 billion US dollar. But if you compare the customs data with the balance of payment data, this data is more related with the cross-border payment, cross-border transactions. You can see actually in the last 1.5 years, on average, the customs data overestimate the trade surplus by around 20 billion US dollars.
Yeah, Liang, sorry to jump in a little bit. So I think you're describing the deficit in the current balance of payments, but some of that deficit, I'm sure, is down to the fact that Chinese corporates are just holding a lot of dollars. Chinese retail investors have also been buying, overseas assets effectively through gold-backed ETFs, which are RMB denominated. So they take the gold price risk, they take the currency risk. Corporates hold on to dollars because they feel that the RMB is going to continue to depreciate. Would it be fair to say that the balance of payments might also change if the sentiment toward the Chinese economy changes? So if authorities can manage to get growth back on track.
I will come back to this question. I will come back to this point. I think the first is really look at the cross-border payment, very simply, fundamental payment, trading, because of trading and because of the investment. And because, I think I say that I think that I want to close my point. Actually, we may already see a peak of the Chinese export due to the increase of tariff last month, this month in the EU and in the US. At the same time, as I said, we have a deterioration of FDIs and the service sectors. So it's very, very large, very, very likely that we will have in Q2. Q2 is already behind us, of course, a negative balance of payment. And at the same time, I think if the momentum of these long-term flows, this is moving very, very slow, very, very slowly, continues, we'll have a further deterioration, maybe in the upcoming quarters. I think this will all bring the imbalance of the dollars, and it will weigh on the renminbi. Of course, you mentioned very, very well. I think another question is, of course, depends on the conversion behavior of the enterprises. Usually in the past, we can see a very procyclical behavior of the enterprises. So if US dollar goes up, so they buy dollar and they build up their dollar holdings. If the dollar depreciates, they sell the dollars. I think in these months we have such. I think it's we have a very big movement, of course, compared to in the last. I think we have already. In last year we have even a 7% appreciation of the renminbi. But nevertheless, it is a very strong appreciation of the renminbi. Of course, it will have impact. I think on the renminbi, especially due to record long, as you mentioned, record long position of the US dollar. So I think they will have impact. But my opinion is that in the short term, they were providing dollar liquidities. They will, I think they will, what we have already seen on the onshore market, they were putting pressure further on the US dollar. But in the middle term, I think the balance of the dollar supply and dollar demand will be the most important driver.
Sure.
For
perfect.
In the middle term.
Great. Well, thank you very much, Liang. And before I let you go, we like to close the podcast with a personal question. I've read that foreign visitors are coming back to China now. You hosted some friends from Germany recently. What are the most exciting things that you showed them, and what would you wish any of our listeners here visiting Shanghai to see and appreciate about the city?
Yeah, I love to be a city guide, and actually my most favorite place to show is actually really the traditional residential areas in Shanghai. Most of them are built hundreds of years ago, and in Shanghai we call it compounds. Usually a compound made of hundreds townhouses with 3 floors and with around 100 square meter living spaces. And they are really, very beautiful, but unfortunately, most of them has been destroyed over the last 30 years to make place for the buildings and for the streets. And but the compound where my dad spent a big part of his life, and I grew up before I went to Germany in 1993. It's still partially there. So a third of it has already been destroyed, but there are still two-thirds left. So every time we have visitors from Germany, I always visit the house and tell them the story about these houses, and they are getting very impressed. So the house where my father was a child, in this house, the whole house was of course only for one family. So my father has brothers and sisters. They live in this house for 100 square meters. But in the 1960s, two families moved into this house due to the rapid population growth in Shanghai, in China, and due to just scarcity of housing. So when I was a child, I grew up also in this house. My parents and my sister, we have only 1.5 rooms, and we
because
have
the other family had moved in.
Yeah. We have only 25 square meters for 4 person. But at that time, we were very privileged because at that time, the average living space in Shanghai was only 4 square meters. So we have more than 50% more than average household. Now, this is the 30 years ago, 1993, before I went to Germany. Now, 30 years later, I'm back in China. The average living space in Shanghai is 40 square meters. So 10
From
times.
4 to 40. Okay, yeah.
Yeah, and in same times, the population grew from 9 million to 30 million during these 30 years. So when I'm telling the story to my friends again and again, what I learned is I'm getting really have a balanced view of what benefits and the costs of the housing market development. And I really see the current housing crisis paying in the growth. So hopefully China can overcome this crisis.
All right. Well, thank you very much, Liang, and we'll close the podcast here and speak again tomorrow. Next week.
All right. Thank you.
Thanks for listening to the episode. Please subscribe to the podcast show on Apple, Spotify, or wherever you listen to podcasts. Leave a 5-star rating, a nice comment, and let other people know about the show. We'd be super grateful. Finally, sign up for our free newsletter at macrohive.com/free. That's macrohive.com/free. We'll be back soon, so tune in then.